The Psychology of Investing, Chapter 18, Mastery Through Mindfulness and Reflection. Mindfulness matters in investing because markets move quickly, but your decisions do not have to. At its core, mindfulness is simply noticing what is happening in the present moment before you rush to judge it or act on it. For an investor, that means noticing your thoughts, your emotions, and even physical signals like tension in your chest or restlessness in your hands. That brief awareness creates a pause between a market move and your response to it. In that pause, fear and excitement can still be present, but they stop running the whole decision. Over time, this makes it easier to stay aligned with your plan, your time horizon, and your risk limits. It helps to be very clear about what mindfulness can and cannot do. It cannot predict where the market is going, prevent losses, or guarantee better returns. If a portfolio declines, mindfulness does not magically remove that reality. Its value is more practical than that. It helps you respond more steadily when headlines, price swings, or uncertainty trigger strong reactions. In other words, it improves process rather than prediction. That distinction matters because better investing usually comes from better behavior under stress, not from perfect foresight. A simple starting practice is the 1-minute breath check. Before you open your brokerage app, read market news, or look at prices, set a timer for 60 seconds and just breathe normally. You can count each breath up to 5, then begin again. If your mind wanders, which it will, simply restart without frustration. The point is not to force perfect concentration or empty your mind. The point is to interrupt automatic behavior, so you are entering the market with a little more attention and a little less momentum. In volatile moments, shift your attention from the screen to your body for just a few seconds. If the market drops sharply or a position jumps suddenly, wait 5 seconds before doing anything. During that pause, notice sensations like tension, pressure, heat, or restlessness, and silently name what you feel. You are not trying to remove the sensation right away. You are learning to observe it without being pushed around by it. This is important because many impulsive trades begin in the body before they become a fully formed decision. Mindfulness also applies to how you review your portfolio. A single task review means giving your holdings your full attention instead of mixing that task with notifications, social media, television, and unrelated tabs. Distraction makes it much easier to react to noise and much harder to compare current events with your actual investment plan. When you remove competing inputs, your thinking usually becomes slower and clearer. You are more likely to ask, what has truly changed here, rather than what feels urgent in this moment. That kind of focus supports deliberate decisions instead of scattered ones. A short reflection at the end of the day can reveal a lot about your investing behavior. Take 2 minutes and ask yourself which feeling most influenced your biggest decision of the day. Then write down just one word, such as fear, excitement, urgency, or boredom. Keeping it to one word makes the habit easier and prevents overanalysis. The goal is not to criticize yourself or produce a deep journal entry every night. The goal is to build a small record that helps patterns become visible over time. Consider Marta, who kept checking prices throughout the day and found that every glance made her more anxious. She started using a 1-minute breath check each morning before looking at any market data. What she discovered was surprising. The tension was already there before she even saw the prices. Her daily notes showed that fear appeared again and again, especially on ordinary days when nothing major had changed. That insight helped her create a practical rule to check prices only twice a day. The market did not become calmer, but her behavior did. If you want to begin, keep it very small. Choose just one of the 4 practices and use it for the next 3 trading days. After each day, write a single sentence about what you noticed, especially any urges, moments of calm, or repeated reactions. You are not trying to prove that you are good at mindfulness. You are gathering information about how your mind behaves around money and uncertainty. Even 3 days is enough to start seeing patterns. Small experiments like this are often more effective than ambitious routines that disappear after 1 week. There are a few common mistakes that make mindfulness less useful than it could be. One is believing you must empty your mind completely, when the real skill is simply noticing distraction and returning. Another is expecting immediate portfolio results, as if a few breaths should translate directly into higher returns. Some investors also try to begin all 4 habits at once, which usually creates friction instead of consistency. And mindfulness should never be confused with passivity or indecision. It is not about doing nothing, it is about pausing so that your eventual action is more thoughtful. The core advantage of mindfulness is simple but powerful. It helps you notice emotions without automatically obeying them. A daily practice creates a small pause before acting, and that pause changes the quality of your decisions. You begin to recognize emotional influence earlier, before it turns into a rushed buy, a fearful sale, or a break from your rules. Repetition matters here, because discipline is built through many small moments of awareness. Over time, your behavior becomes more consistent with your long-term strategy. That consistency is one of the most valuable psychological edges an investor can develop. Mindfulness becomes especially valuable when markets trigger fast emotions. Reactivity is not just having fear or excitement, it is acting from those emotions before clear thinking has a chance to catch up. That is how investors end up panic selling during declines or chasing rallies after prices have already surged. In both cases, the deeper problem is that the decision is driven by urgency instead of process. Reactivity often feels decisive in the moment, but it usually pulls you away from your long-term plan. Reducing that automatic response is the real goal of meditative practice in investing. The goal of these techniques is not to become emotionless. Emotions often contain useful signals, such as a sense that risk feels high or that excitement is clouding judgment. Meditation does not erase those feelings, and it should not be expected to. What it does is create a little space between the feeling and the action. In that space, you can notice the impulse instead of becoming the impulse. This allows your choices to become more balanced, because awareness arrives before reaction takes over. A practical routine to remember is this: notice, label, pause, choose. First, notice what is happening, both in the market and inside yourself. Second, label the emotion clearly, using simple words like fear, urgency, greed, or excitement. Third, pause before acting, even if only for a few minutes. Finally, choose based on your plan, rather than on the emotional wave passing through you. This 4-step sequence is useful because it is short enough to apply in real time. Under stress, simple routines are the ones you can actually use. One way to strengthen this skill is with a 5-minute breath counting practice. Sit quietly, breathe naturally, and count each exhale from 1 to 10. When your attention wanders, gently restart at 1 without treating it as a mistake. That return is the training. You are teaching your mind how to drift, notice the drift, and come back. In investing, that same ability helps when attention is pulled toward panic, excitement, or urgency. You may not stop the first emotional reaction, but you become better at recovering your balance. Once you feel settled, practice naming emotions directly. Bring to mind a recent market event, perhaps a sell-off, a rally, or a headline that unsettled you. And notice your first reaction. Pay attention to body signals as well, such as a tight chest, racing heart, or restless hands. Then give the emotion a simple label: fear, anxiety, urgency, greed. Try not to launch into a long explanation about why you feel that way. Naming the emotion clearly, without judging it, often reduces its intensity and makes it easier to respond with discipline. The real test comes when you bring the pause into actual decisions. If you feel triggered by a sharp market move, stop before you click, trade, or make any change. Take 3 slow breaths, count each exhale, and name the emotion that is present. This may sound almost too simple, but brief pauses are often enough to interrupt an impulsive action. They give your thinking mind a chance to rejoin the process. Even if you still decide to act, that action is more likely to come from reflection rather than reflex. After the pause, the quality of your question matters. Instead of asking, "What do I feel like doing right now?" ask, "What is the wise move here?" That question pushes you back toward goals, evidence, and your established process. Check your plan, your risk limits, and whether this is a moment that actually calls for action. If you normally make decisions on a schedule, respect that schedule whenever possible. And if the answer is unclear, waiting is often more disciplined than forcing a trade just to relieve discomfort. Reactivity usually follows familiar triggers, and learning those triggers helps you intervene earlier. Sharp declines often trigger fear. Breaking news can create urgency, and rapid gains can spark greed or fear of missing out. Personal patterns matter too, such as checking markets when tired, stressed, or bored. The key is to notice what tends to set you off before the impulse becomes action. Once you know your common triggers, the pause no longer feels random. It becomes a planned response to a recognizable pattern. Imagine Maria seeing a crash headline and a sudden portfolio drop on her phone. Her first impulse is immediate: sell before things get worse. But instead of reacting, she puts the phone down and takes 3 slow breaths. She labels the feeling honestly as fear. Then she returns to her long-term plan and checks whether anything fundamental has actually changed. The value of the pause is not that it predicts a quick recovery. The value is that it helps her choose discipline over panic. Steadier reactions are built through repetition, not through a single good moment. A useful pattern is to practice for 5 minutes each morning, reflect briefly each evening, and then begin using the technique in real market moments by day 3. After about a week, review what you noticed about your triggers, your emotions, and your actions. This process turns meditation from an isolated exercise into a behavioral skill. You are not just calming yourself, you are training for better decisions under pressure. That is how a pause becomes a habit instead of an exception. The key takeaway is that meditative techniques do not remove volatility or guarantee perfect choices. Markets will still move sharply, headlines will still provoke emotion, and uncertainty will still be uncomfortable. What these practices can do is help you detect emotional pressure before it becomes impulsive action. Pause before reacting, label what you feel, return to your plan, and choose with discipline. That sequence will not make investing easy, but it can make your behavior steadier. And in investing, steadier behavior often matters more than intense conviction. Mindfulness helps in the moment, and reflection helps across time. Long-term investing results are shaped by many small decisions, repeated again and again, not just by a few dramatic moments. Regular reflection lets you see whether those repeated choices are helping you or quietly hurting you. Helpful habits compound, but harmful habits compound too. The purpose of reflection is not to hunt for one terrible mistake and feel bad about it. It is to notice recurring patterns so you can make better decisions with more awareness. Good reflection requires a little distance from the emotional heat of the moment. If you review a decision while fear, excitement, or urgency is still stirring, you are likely to defend it or distort it. That is why a weekly or monthly review schedule often works better than immediate self-judgment right after a trade. Choose a quiet time outside market hours when your nervous system is calmer. Then ask simple questions like, what did I do? And why did I do it? Fairer assessment usually comes when emotions have settled enough for honesty to become easier. Reflection works best when the system is simple and repeatable. Put the review on your calendar so that it becomes a routine rather than a vague intention. During the review, list each recent trade or decision and record basic details such as the date, the action, the price, and your reason. Include times when you chose not to trade as well, because restraint is also a decision. This creates a usable record of your behavior. Over time, patterns become much easier to spot when your observations are concrete instead of relying on memory alone. One of the most important rules in self-review is to judge the process, not just the outcome. A good decision can still lose money in the short run, and a poor decision can still make money because of luck. If you focus only on results, you may accidentally reward bad habits and discourage good discipline. So ask whether the decision fit your plan, followed your rules, and stayed within your risk limits. Those questions reveal quality much better than short-term profit and loss. This mindset protects you from confusing luck with skill. As you review your decisions, look for repeated behaviors rather than isolated incidents. Patterns may show up in what you do, in how you feel, or in how often you break your own rules. Maybe you sell too early after small declines, hold losers too long, or become overconfident after a gain. Maybe the same emotion appears before the same kind of mistake. Once you write a pattern down clearly, it becomes more manageable. What was once a vague frustration becomes a specific behavior you can work on. When you identify a pattern, resist the urge to fix everything at once. The better approach is to choose the most harmful pattern and make one small, practical adjustment for the next review period. That adjustment should be specific enough to observe, small enough to test, and realistic enough to repeat. For example, instead of saying, I will be less emotional, you might say, I will wait 24 hours before selling on fear. Then, at the next review, ask whether that change actually helped. Improvement usually comes from focused experiments, not sweeping promises. Maria's weekly review shows how powerful a simple record can be. Every Monday, she reviews her recent trades and writes down why she entered, why she exited, how she felt, and whether she followed her rules. Looking across 6 trades, one pattern stands out. She often sells early after small declines. Her original reasons for buying usually had not changed, but anxiety kept overriding her plan. Without the review, each sale might have felt like a separate event. With the review, it becomes clear that the same emotional pattern is repeating. Once Maria sees the pattern, she turns it into a behavioral experiment. For the next week, she sets one rule. If her thesis is still intact and the decline is less than 3%, she will hold for at least 5 trading days. This is not a promise to ignore all risk or never sell. It is a focused test designed to interrupt a specific habit. The rule is useful because it is clear, limited, and measurable. Reflection becomes powerful when insight leads to an action you can actually practice. For reflection to keep helping you, it needs to stay honest and neutral. Review your wins as well as your losses, because both can teach you something. Keep your notes factual instead of dramatic, and try not to overreact to whatever happened most recently. Harsh self-talk usually reduces learning because it makes you defensive or avoidant. And if you miss a review, simply return to the habit at the next opportunity. The goal is observation and growth, not punishment. Once you can notice patterns, the next step is to design a written plan for improving them. A psychology improvement plan gives structure to the mental side of investing, especially when emotions run high. Instead of hoping you will behave well under stress, you create a simple system for responding more deliberately. That system can focus on decision quality, emotional habits, and the moments where you tend to get pulled off course. A written plan is useful because it turns vague intentions into visible commitments. In difficult markets, that clarity can matter a great deal. A practical plan should answer 3 questions. First, what habit am I trying to improve? Second, what action will I practice instead when that habit shows up? Third, how will I measure whether I'm making progress? These questions keep the plan grounded in behavior rather than in vague self-description. They also force you to move from awareness to action. If you can name the habit, define the replacement, and track the result, you already have the outline of a workable system. The best plans are short enough to survive busy days and stressful markets. A brief daily mindfulness habit, a simple trigger log, and a weekly review are often enough to create meaningful change. If the plan becomes too elaborate, you will probably abandon it precisely when you need it most. Simplicity is not weakness here. It is what makes consistency possible. The aim is not perfection or complexity. The aim is a repeatable process you can actually use when emotions begin to rise. Start by choosing one target behavior that repeatedly causes trouble. Make it specific and observable so you can see it, count it, or record it. Saying I am too emotional is too vague to help. Saying I check my portfolio 12 times before noon, or I sell after a 2% drop on the same day, gives you something concrete to work with. Writing the behavior down clearly matters because it removes ambiguity. Once you know the old habit, define a replacement action in advance. Behavior change becomes much easier when you decide ahead of time what you will do instead of relying on willpower in the moment. The replacement should be tied directly to the trigger and simple enough to repeat. For example, if a market drop triggers anxious checking, the replacement might be one scheduled check and a written note before any trade. If news headlines trigger impulse buying, the replacement might be a 15-minute wait and a rereading of your thesis. Pre-deciding the new action reduces the odds that emotion will choose for you. A measurable goal makes improvement visible. Instead of setting a vague aim like be less emotional, use a specific time frame and accountable action. You might decide that for the next 30 days, you will check your portfolio no more than once per day. That gives you something clear to track with a checklist, a calendar, or a notes app. The purpose of tracking is not to judge yourself. It is to gather feedback so you can see whether the new habit is actually taking hold. To make the plan stick, build it into daily and weekly routines. A 1 or 2 minute mindfulness practice is enough if you attach it to a regular event, such as before opening your investing app or before reading market news. Then, once a week, review how often you followed the plan, when it felt hardest, and what triggers appeared most often. This turns the plan into a learning system instead of a one-time resolution. Daily practice helps you notice, and weekly review helps you improve. Your plan should evolve as you learn more about yourself. A habit that once needed attention may improve, while a different pattern becomes more important. That is why a monthly review can be useful. Look at what is working, what is still difficult, and whether new triggers have appeared. Then adjust the plan without making it overly complicated. A realistic plan is not static. It changes as your awareness grows and your behavior becomes more refined. Dan offers a clear example of how simple this can be. He notices that anxiety leads him to sell too quickly after small declines, especially after a 2% drop. So he creates a response system. Pause, breathe, and review his original reason for owning the investment. His goal is modest but specific. No immediate selling for the next 3 weeks. During that time, he tracks the urge to sell, whether he followed through on the pause, and when the urge was strongest. He still feels nervous during dips, but his behavior begins to improve because the plan gives him structure. Most psychology plans fail for predictable reasons. People try to change too many habits at once, use goals that are too vague to track, skip the weekly review, or expect perfect performance. Others make the plan so complicated that it becomes another source of stress. A strong plan is simple, specific, and usable. Setbacks will happen, and that does not mean the plan is failing. It means you record what happened, learn from it, and continue with consistency rather than intensity. All of this leads to a larger idea. Investing is not something you master once and then finish. Many people hope for a perfect strategy that will solve everything, but markets change, economic conditions change, and people change too. Your goals, your responsibilities, and your tolerance for risk can all evolve over time. That means successful investing requires ongoing learning, not just technical knowledge, but self-knowledge as well. Staying teachable is one of the healthiest attitudes an investor can carry. Mindfulness and reflection work best when they support each other. Mindfulness helps you notice thoughts and feelings in the present moment, before they turn into automatic reactions. Reflection helps you look back and understand what influenced your past decisions. Together, they create a loop of awareness and learning. You become better at interrupting old patterns because you can spot them both in real time and in review. That combination makes learning more durable than insight alone. A mistake does not have to become a personal verdict. A disappointing trade, a rushed sale, or a missed opportunity can all become useful feedback if you examine them honestly. The important question is not, what does this say about me? But what does this reveal about my process under pressure? Maybe you rushed, ignored your plan, or sized the position poorly. Those are painful lessons, but they are also actionable ones. When mistakes become information, they stop being dead ends and start becoming part of improvement. Continuous learning helps you spot the mental habits that repeatedly distort judgment. Perhaps you become overconfident after a win, overly fearful during declines, or impulsive when headlines feel urgent. These patterns may not disappear completely, and that is okay. The real progress is noticing them earlier. Earlier awareness creates a chance to pause before the habit becomes action. That shift from reacting automatically to responding thoughtfully is one of the clearest signs of growth. Learning does not have to mean consuming endless books, podcasts, articles, and alerts. In fact, too much information often creates more noise than clarity. A few small, repeatable habits usually work better. A short reading period, a brief reflection, one written note, and a simple review routine. This keeps learning sustainable instead of overwhelming. Consistency matters more than intensity because steady habits compound. The goal is not to know everything, but to keep improving in a way you can maintain. A useful learning rhythm can be built around 4 steps: notice, review, test, and reflect. After each important decision, write one brief note about what you did and what you felt. Each week, review those notes for patterns. Each month, test one small change based on what you are noticing. And each quarter, step back and reflect on whether your decision quality is improving. This kind of rhythm keeps learning active without making it burdensome. It turns growth into a cycle instead of a vague intention. When a recurring pattern becomes clear, turn it into a small experiment. If fear keeps pushing you to sell too fast, test a 24-hour waiting rule for a month. If news keeps tempting you to buy impulsively, require yourself to reread your thesis first. If volatility makes you restless, observe without acting unless your plan clearly calls for action. The key is to change one habit at a time. Experiments work because they are manageable, measurable, and less emotionally loaded than trying to reinvent yourself all at once. Leah is a good example of small, steady progress. At first, she was overloaded by too much content, too many opinions, and too many signals competing for her attention. Instead of trying to master everything, she adopted one repeatable habit, writing a single sentence after each trade. That small routine helped her notice that breaking news often created urgency and pushed her into impulsive decisions.
So she added a 24-hour pause before acting on major news.
Her improvement did not come from knowing more than everyone else. It came from simplifying and paying attention. A simple learning journal is one of the easiest ways to begin this process. Start with your last 3 decisions, whether they were buys, sells, or choices to wait. Write down what you were thinking or feeling at the time, without judging it as good or bad. Keep the note plain and honest, rather than polished or impressive. Then save it for later review. The journal becomes valuable, not because each note is profound, but because repeated notes reveal patterns your memory would miss. As you continue learning, watch for a few common traps. Do not wait for a big mistake before you decide to learn something. Do not collect notes without reviewing them, because unused observation quickly becomes clutter. Avoid comparing your progress to other investors, whose goals, personalities, and risks may be very different from yours. And do not try to change everything at once. Continuous learning works best when it is regular, focused, and centered on your own steady progress.